Hey guys, I'm Jeremy with eXp Commercial. Today we're going to do a quick dive into the world of 1031 exchanges, a unique tax deferral strategy that empowers real estate investors to grow their portfolios and maximize profits. Let's go. A 1031 exchange is also known as a like-kind exchange or a tax-deferred exchange, which is a provision in the U.S. Internal Revenue Code Section 1031 that allows real estate investors to defer capital gains taxes when they sell one investment property and reinvest the proceeds into another like-kind property. The primary purpose of a 1031 exchange is to encourage investors to continue investing in real estate by providing them with tax advantages. To qualify for a 1031 exchange, both the property being sold and the replacement property must be held for investment or used in a trade or business. This means that the property is held primarily for personal use, such as a primary residence, does not qualify for a 1031 exchange. The term like-kind in the context of a 1031 exchange does not refer to the properties that are exactly the same, but rather to properties that are of the same nature or character. In other words, real estate investors can exchange one type of investment property for another, as long as both properties are held for investment purposes. For example, a commercial property can be exchanged for another commercial property, or a residential rental can be exchanged for another residential rental property. The replacement property must be of equal or greater value than the relinquished property. There are specific timeframes that must be followed in a 1031 exchange. Once the relinquished property is sold, the investor typically has 45 days to identify potential replacement properties and must complete acquisition of the replacement property within 180 days from the sale of the relinquished property. These timeframes are critical, and any failure to comply may result in disqualification of the exchange, leading to immediate tax liability. If you're currently in the 1031 exchange and are close to these deadlines, no worries. Just reach out to your local tax consultant and they'll be able to possibly move you into an extension or move you into another type of vehicle such as a DST. By utilizing a 1031 exchange, investors can defer paying capital gains taxes that would otherwise be triggered by the sale of their property. Instead, they can use the full proceeds from the sale to acquire a new property, potentially allowing for more significant portfolio growth and increased cash flow. In essence, a 1031 exchange provides a valuable tool for investors to swap investment properties and reinvest in real estate without being immediately burdened by capital gains taxes. However, it is essential to consult with tax and legal professionals to ensure compliance with all the rules and regulations surrounding a 1031 exchange to take full advantage of this tax deferred strategy. Thanks for watching. If you have more questions about 1031 exchanges, I suggest reaching out to your local CPA or tax professional. They'll be able to give you much more detail and information on this subject. If you have more questions about commercial real estate, feel free to reach out to me, 702-232-0179. I look forward to connecting with you soon.